All right, let's move forward in central banking news. Kenya's Monetary Policy Committee has cut the country's key lending rate to 9.25% by 25 basis points, and that's the 8th straight easing by the regulator. In a post-Monetary Policy Committee media statement earlier today, the Central Bank Governor, Dr. Kamau Tuje, outlines key developments such as lower inflation rate, a stronger credit growth to the private sector, and stable exchange rate of the shillings as major considerations for the policy easing. Let's take a listen.
The MPC observed that overall inflation is expected to remain below the midpoint of the target range in the near term, supported by stable energy prices and continued stability of the exchange rate. Although some central banks in the major economies have remained cautious in lowering interest rates, others, depending on their inflation and growth outlooks, have continued to ease their monetary policy. The average lending rates in the domestic market have continued to decline gradually, while private sector credit growth has continued to improve, though at a lower pace than is desirable. The revised banking sector risk-based credit pricing model, which will be fully operational by March of 2026, will improve the transmission of monetary policy decisions to commercial banks lending interest rates. The committee therefore concluded that there was scope for a further easing of the monetary policy stance, and this will augment the previous policy actions that were aimed at stimulating lending by banks to the private sector and supporting economic activity, while at the same time ensuring inflationary expectations remain firmly anchored and that the exchange rate also remains stable. The MPC will closely monitor the impact of this policy decision, as well as developments in the global and domestic economies, and stands ready to take further action as necessary in line with its mandate. The committee will meet again in December of 2025. The committee, while making that decision, also looked at global economic developments as well as domestic developments. In regard to the global economic developments, the committee noted that despite higher tariffs, global inflation is projected to decline in 2025 and 2026, mainly driven by lower energy prices and reduced global demand. The overall inflation is projected to decline from 5.6% to 4.2% this year, and a further reduction to 3.6% in 2026. The international oil prices have moderated due to increased production and subdued global demand, but have been volatile due to elevated global uncertainties. Looking forward, the oil prices are expected to remain moderate, mainly reflecting increased production by the OPEC Plus as well as the non-OPEC producers, and reduced global demand. The OPEC Plus countries announced on October 5th, 2025, that it will raise output by 137,000 barrels per day in November of 2025. The main risks to oil prices relate to higher tariffs and any supply disruptions from escalation of geopolitical tensions, particularly the conflict in the Middle East and the war in Ukraine. In regard to food inflation, inflation declined in September 2025 from 6.6% to 3.4%, and this was driven mainly by lower cereals and sugar prices inflation, but edible oils price inflation remained elevated, although even for the edible oil price inflation, there was a deceleration from 24.3% to 18%. Looking at some specific major economies, the inflation in these economies has increased modestly in recent months, and this has been because of higher food prices, as well as the impact of the higher tariffs. In the case of the US, headline inflation rose in August 2025, partly due to the effects of higher tariffs on imports. Their core inflation held steady at around 3.1%. UK inflation remained relatively elevated in August at 3.8%, despite a decline in core inflation. Eurozone inflation rose slightly in September 2025 from 2% to 2.2% due to higher food prices, but core inflation remained relatively stable at around 2.3%.